Hey everyone, welcome back to our podcast here. And today we have our special guest here, Mr. Ocean Pon. Right, Ocean, can you briefly introduce yourself?
Yeah, Xiang, I think actually basically my background is a bit different with I think most of the financial planners out there because I actually study actuarial science. But I think I didn't really spend my time in actuarial industry. I only worked for 3 months in actuarial industry, for 3 months as an actuarial consultant lah. But later on I convert to an insurance agent for 6 years. So actually I worked quite for a long time in insurance agency industry. So after that, I converted myself as a financial planner and
6 years being an insurance agent.
Yes, true.
That's quite a long period. So what makes you become a licensed financial planner?
Actually, the reason of becoming an LFP, right, or we call licensed financial planner is, I keep thinking after 6 years in agency, right, actually I keep thinking like, what is the way I can so-called enhance my values towards my clients? Because I think I appreciate my clients, they actually trust me a lot. But the thing is, other than insurance planning, what else can I offer? What else can I give them as a value of becoming my clients? So later on, I think financial planning is a very, very important thing, no matter in what stage of life. So this is why I become an LFP and then want to help them in doing their financial planning.
I believe in the financial planner industry, there are a lot of misconceptions. So can you briefly explain a little bit about this? What is a financial planning process and what does a financial planner does on a day-to-day basis?
For me, I think financial planning process, right? We don't make it complicated. For me, it's actually very simple. It's just like room keeping.
Room keeping.
Yeah, it's just okay, but maybe it doesn't really good to say that we are a room keeper or what. Why do I say so? It's because as a financial planner, actually we do help clients to keep their financial things in accordingly. Because a lot of people actually they don't have time. Firstly, of course, they don't have time, or of course they don't have this kind of knowledge to really manage their financials. So because a lot of people day to day they are busy on their works, on their jobs, and of course they need to work very hard to earn more money, right? So this is what people mostly they will focus on. So as a financial planner, we help them to so-called welcome the financial planning process. Firstly, we help them to gather all their informations. Of course, only financial informations. And of course, secondly is their financial goals. Okay, so financial goals, they are not only limited to buying a house, it's also can be expanded to when do you want to get married, when you want to get your first child, and of course so on. So this is what we call financial goals. And later on, we also will help them to do all the calculations, all the, I can say, tedious work. We help them to do all the tedious work. And after that, of course, is help them to implement a plan and work towards to reach their goals. So this is how the financial process, in a simplified version, how it goes. And of course, just now you say some misunderstanding, right, Yang?
Yes, correct.
I think the biggest myth, I can say biggest myth or biggest misunderstanding about financial planning is financial planning is only for rich. I'm not sure whether our audience here today will have this kind of questions or not. But I think a lot of people out there, they do think that, why do I need financial planning? It should be only for those very rich people, right?
Yes.
But I think the key is, if we never plan, how could we get rich? So this is the thing that actually no matter how much you have, it's always best to start to do a plan. No matter it's your DIY plan or you engage a financial planner to help to plan it, it's always there's no best time to start. It's always now to start to do the financial plan.
Yeah, talking about financial planning misconception, and specifically when we are talking about financial planning is only for the rich, right? And I think many people also misunderstood that financial planning is also a very expensive service to engage with or to begin with. Yeah, what do you think about that?
Of course, it depends on different contexts. Of course, in certain countries or in certain different places, they might have some privileged financial planning service for those high net worth people, high net worth clients. But actually in Malaysia, right, or I can say in Finwealth, actually we are offering quite a reasonable financial planning service towards our Malaysians clients. Because we do know that as probably I can say N40 in Malaysia, they have money to plan, but they don't have a really proper way to plan for it. So actually in Finwealth, right, we do offer a reasonable fees for financial planning services.
Yeah, so you're saying that financial planning service is actually a customizable service.
That's correct. As long as they follow the financial process, actually can do it in a simple way, even the DIY way. Yeah, or of course, if let's say they need certain help like from professionals like us, they can definitely get from us.
I see. So coming back to this financial planning service, I believe you always come across this question like how to manage your debt effectively, right? So do you have any tips on this one?
If let's say talk about that, right? So I think Malaysia is one of the nations that a lot of people struggling with their debt. So for me, right, I think the first thing you need to understand the debt first. So actually in debt, right, we should separate into good debt and bad debt. So for the good debt, right, so we are categorizing those assets or those debt that help you to so-called generate your net worth, or in other terms we call is helping you to have more money. So for example, like a housing loan, so it's one kind of good debt. Because why? Of course, first thing, housing loan, once you like repaying everything, then this is considered an asset. And in another way also, property will also appreciate in their value, right? So this is one kind of good debt. But in other way, in the other side, which is the bad debt side, we can talk about like credit card debt. So the firstly, of course, I think every Malaysians know that credit card have very high interest of about 15 to 18% per annum. So it's really very high. And another thing is, usually people spend credit card on some, of course, some of them spend some on necessity, but a lot of time we are spending on shopping, on buying some unnecessary things. So if let's say we don't really control on this kind of bad debt, right? So it can easily burn up our savings, even our whole life, I can say.
I think that's a good point. So there are good debts and there are bad debts. So when it comes to good debts, like the current gig economy, people buy a car to do, to be a Grab driver. I think for those that whoever who are doing that, I think those are considered as good debt. And for bad debt, that means actually those debt does not really help you generate an income in that sense. Yeah. And what do you think of becoming financially independent? Do you have any tips on that one? And what do you think of these terms, financial independence?
Of course, I think everyone should have their own definition on financial independence. Like for me, if let's say for me, I think as long as I have enough of passive income to survive the kind of lifestyle that I want, is considered financial independent. But of course, maybe for someone like listening to this podcast, right, maybe they need a very big bungalow or they need a Lamborghini even. So it's considered their so-called lifestyle, their dream lifestyle. So it really depends on what kind of financial independent definition you want. So this is, I think always we heard people about they want to become financially independent. So the first thing I think you need to think about is what kind of lifestyle is considered as financially independent for you. And of course, the next step, I think, since you already have the definition, right, of your own self, then of course you should start plan on it. So I think figure is always have to come back to figure. So you need to so-called numberize like what's the amount that you really need. If it's 1 million, 2 million enough, or you need 10 million. So it really depends on the kind of lifestyle you want. And after plan it, of course, you need to think like, how can I get the 1 million, right? This is 1 million. So how are you going to save for 1 million? So after you have a plan, then you should implement the plan. Of course, later on, you need to do the so-called tracking, or you need to make sure you are on the track to save so-called this amount of 1 million.
Yeah, so talking about this retirement or even being financially independent, and because I see a lot of news today that they are relating quite a lot of, when people retire, we can see that they have a lot of debts ongoing. That means they haven't fully repaid their loans yet. So is there any way for people to prioritize the different types of debt, and how should they pay off this kind of debts?
I think what Shian said is really true for most of Malaysians. When they come to retirement, right, I think the biggest trouble for them is, I'm near to my 50s or 60s. I still have a lot of debts. I still owe a lot of money to banks. So when it comes to debt management, right, I think the first thing, actually there are two ways to manage the debt. So maybe the first time is, some people will use this way, which is they will repay those debt with the highest interest first, which is what we call the expensive debt. For example, credit card or personal loan, this kind of like so-called expensive debt, then we should repay first. Okay, so this might involve a bit of calculation, a bit of study on. You need to list out every debt that you have. Then you should prioritize which one you should pay first. And I think the second way, which is I think for most of the laymen out there, it's easier to do, is you start from the minimum amount first. So for example, you have like 3 debts in hand. So you should start repaying those like with the lowest amount first. So actually through the process of repaying, your own self, you also can get certified. Because I think certification is also very important when it comes to financial planning. You need to have a motivation to keep on doing, right? Because it's not a one-day thing or not even a 1 month thing. You might need few years to finish to repaying all the debts. So it's really you need to have a motivation to do this. So my suggestion is you can always start from the lowest amount, then slowly you move to the next and later on you can finish all the repayment.
How can an individual prepare for unexpected financial emergencies?
If let's talk about emergencies, right? I think Malaysians, or I think the whole world do experience an emergency. In the past 2 years, which is the MCO, right? COVID-19. So I think the first when it comes to emergency steering. So of course, the first thing you need to have emergency fund. So I think the things that last time there's a statistic show, there's actually research. I think it's quite scary. So it's talk about 80%. I'm not sure about the right figure, but I think it's about 80 or 90% of Malaysians not even have a 1,000 savings in their own account. So I think this is quite scary because when it comes to emergency fund, right? So it's like a safety net for every one of us because we never know what will happen next, right? So it's always good to have a certain amount of emergency fund. So if let's say talk about emergency fund, usually I would suggest my clients to have at least about 6 months of their expenses as a so-called emergency fund in hand. So if let's say 6 months expenses is a bit hard to calculate, so I think for all of you, you can think about 6 months income.
What are some of the specific steps that someone can take to save up this kind of emergency fund?
I think a lot of my friends around me, they do also know that importance of emergency fund, but like what Chi Yang said, a lot of people don't really. They will say, it's very difficult to have savings nowadays. Everything is very expensive, right? But I think the first thing is you need to so-called set a goal. I just set a goal is very important. For example, let's say your goal of emergency fund is 10K. So you need to start calculate. If let's say this month I got my salary, is it possible for me to save up 10% first? So it's a base. When it comes to financial planning, we talk about save first, spend later. So it's same for the cash reserve or emergency fund also. You need to save first before you spend. So this is the way that you can start to slowly build up your so-called cash reserve.
Regarding the emergency fund that you have mentioned just now, I actually have a lot of friends also who know the importance of having an emergency fund, but then eventually they just save for about 2 to 3 months of an emergency fund. Then eventually they see the amount, then they will go and utilize or go and use the amount already. What do you think of this one?
I think thanks to Cuti Malaysia. Last time I also do have the same problem as well where I decided myself, I want to save. So after saving for a few months and having a few thousand in the account, then later on, suddenly there's a promo or there's a so-called affair or Cuti Malaysia. So then we spend it all one time. So I think the best way to so-called have this emergency fund is always to have a separate account. Some account that you never touch, that not even you will see it always. So for me, right, I do save my emergency fund in an account, in a bank account, without debit card, without an ATM card, so-called. So it's actually restrict me to do all the unnecessary withdrawal. So whenever I think, I need to touch my emergency fund, then I will think about, it's very troublesome. I need to queue up in the bank, I take the numbers, and then queue up to take the so-called, just do the withdrawal. So it's actually helped me to stop me also from me to withdraw from the cash reserve, from the emergency fund. So I think it's a good way to share it off you.
Yeah, I think when it comes to that, having the psychology barrier to hinder yourself from taking the money, we should be saving each and every financial goal into different kind of jars, right? So let's say, for example, an emergency fund, we need to be saving it in an isolated account, and even for other financial goal also, we should be saving all this kind of financial goal in an isolated account instead of having all of them jumbled up together.
True. I think what Chiang's saying is about the very common concept in our industry, which is what we call jar savings. So it's like you can imagine you are having a different kind of jar, numbers of jars in front of you. Then you put in your money like this one for retirement, this one for emergency, this one for your Gucci bag, for example. So yeah, I think it's a good way because a lot of us we don't really. I think a lot of people practice one thing called all-in-one savings. So they're just like what Chiang said, they just jumble up everything. So actually, we don't suggest it because when it comes to like you do saving this way, right? It's easy for you to confuse. You might think that you have money to spend, but actually not. For example, you have 10K, but when you want to go for travel, you might think that, hey, I have 10K in my hand, but actually this 10K should be for emergency fund. So you must mix up. Or you must get confused. So it's always the best practice is to separate different of your financial goals into a different kind of savings account.
So being a licensed financial planner yourself, can you share with the audience a bit of what are some of the key factors to consider when it comes to retirement planning? Because there has been this quote in recent times called FIRE, Financial Independence, Retire Early. Yeah. Can you share with us a bit on that one?
Yeah, I think nowadays we always hoo-ha say 5 year, right? I think it's a dream for everyone, but of course, you want to make your dreams come true, have to go back to the basis. I think the basis of retirement is always about numbers. So the first thing, of course, you need to think about how much you want to spend every month when you come to retirement. And of course, secondly, since you want to so-called retirement, retire early. So when is your exact retirement age? So for the usual one, it's about 60 years old, right? So if let's say you're going to retire on 60, and we expect that we can live until 80 so we still have 20 years to survive. I cannot say survive. We have 20 years to enjoy retirement life. So if let's say in these 20 years, how are you going to spend your life? Are you going to spend 3,000 per month or 5,000 per month? It's totally a different lifestyle, right? So this is what I think we should really go into the deeper way to find out the real retirement number we should have.
So regarding this one, so how do an individual can, make sure their retirement is on track? It won't be like suddenly, oh, I don't have money next year already. So what do they do? How do they make sure they are on track?
To make sure someone on track, right? So I can say review is really important because like in Finwealth, when clients look for us to do their financial planning or to do their retirement planning, we always have this so-called quarterly review, annual review, so to help them to make sure they're on track on so-called finishing their goals. So it's always very scary when I think a lot of people only notice or only look at their retirement when they come to 50s or even 60s. You can think, you can imagine, it's already the time is too rushed when you want to plan for it when you're already 50 or 60s. So it's always reviewing is really very important when it comes to retirement planning, so you can ensure that you have the right amount. So I think when we talk about right amount, right, maybe I can share a simple example here. So for example, your ideal amount of retirement is about you need to spend 3,000 per month. So yeah, 3,000 per month. So times 12 for 1 year is about 36,000. So if let's say you are going to spend 20 years retirement life, so definitely you need to time 20 years, it's about 720K. Yeah, 720. So it's close to 1 mil. But don't forget, so this is just a rough number that you get. But at least you need to know you need to have a 700K in your account.
I think that's a good one because when people, they starting to get nearer to retirement, then only they realize, they don't have enough money to actually retire. Yeah, so I think that comes with the concept of what we call compound interest also. Because the later that they save, the later they start saving, the harder it is for them to get the retirement number that they hope to achieve. Right. So talking about financial plan and retirement planning, right? So how can an individuals, before we are even in our retirement age, we will come through many stages like buying the very first ticket, big ticket items like purchasing a house or even preparing for marriage and also starting a family. So how can an individuals plan accordingly for all this?
I think what Xian mentioned is really important. It's talk about my so-called major life events, right? So like marriage, buying the first house, or even starting a family, so with child some more. So a lot of people, if let's say you don't really plan, So you will really get a sudden heart attack, right? We can say sudden attack. Because I do heard about stories that people borrow to get a so-called dream wedding. And in the end, it's not a good story, lah. So they're bear about 100,000 loan and need to pay for many years, pay back many years. So like what we say in front, when we will really confirm that we have different kind of financial goals in life, or what we call major events going to happen in life, definitely we can plan earlier. So for example, let's say about wedding, a marriage. So if let's say we are going to allocate about 100K into a wedding, so probably going to have this marriage, this wedding in 3 years' time. Then before 3 years or even earlier, we can already start to save or start to invest to so-called to finish or to have this amount of money in hand when in 3 years' time later. So this is what we call plan earlier. So this is what we always help the client to do when we come to do the financial plan. When we have the financial plan, we always need to ask about, hey, clients, Mr. Client, what are your financial goals in your near term, in your mid-term, and in your long term also?
I heard you mention the word invest just now. I think there's a lot of misconception also on this one. So because I always thought that, or even many people thought that we should be just savings towards the goal instead of investing. So are you saying that we should be investing towards each goal?
Of course, it depends. If let's say it's a near, like what we know, it's a very near-term goal. For example, in our firm, we do have this standardization. If let's say the goal is going to happen in 3 years' time, so we don't suggest to for the clients to put their money for this goal into investment. But look at other way. If let's say we have 10 years out, even we have 30 years to go for our retirement, right? So if let's say we only use savings to save for our retirement, so it might take up a longer time or even a bigger amount. So actually investment is the type of like what we call accelerator to so-called boost up your savings. To have your savings to have more values in the end of goal time. So this is what we call invest is also a very, very important part when we come to do financial planning.
Because I heard most Malaysians, they invest in unit trusts, they invest in stocks on their own, and also they invest in real estate. So what do you think of these investments?
I think different kind of investment, we call it investment vehicles. Of course, this vehicle is not the same as the one then on the road. So when it comes to investment vehicles, right, like Chiang mentioned, we have the most common one, stocks, unit trust, and real estate. So real estate is like those kind of like residential house or even commercial shop block. So when talk about these three things, right, what I should say or what I can share with the audience here is each of them actually have different kind of like the things that you should be aware of. For example, stocks, definitely when it comes to direct stock investing, you need to know it's very volatile. Generally, stocks have this so-called volatility in itself. So you need to spend a lot of time, you need to do your own research so that you can success in stock investing. And of course, second, real estate. Actually, real estate also the same as well. You need to spend time to find the right location. You need to bargain for the right so-called price when you want to buy a house, because it easily goes to 100,000 or even few millions, right? When you come to real estate investment. And the last one is what we call is the unit trust, right? I think unit trust is quite common in Malaysia. A lot of people invest in unit trust also, but I'm not sure. Yeah. A lot of people, a lot of surrounding friends, they do tell me unit trust cannot trust. I don't know whether you heard about this before. Yeah, but this is a really funny thing, funny phrase that I heard of. But actually, unit trust is just another form of stocks investing. Yeah, unit trust, a lot of people might not understand about it, but it's actually just buying into a basket of companies. Stock is buying into a single company, right? So unit trust is just buying into a basket of companies. So of course the pros of the advantage of buying into unit trust, you can do diversification on your own, because definitely you already buy into different, not only one company, it might be 30s or even hundreds companies in one unit trust fund. So a lot of time I can say unit trust is quite suitable for those laymen, let's say for those investors that they don't have time to really do a very depth research into single company.
Yeah, so talking about diversification, right? Many people they say they invest in this company and in that company, and in many companies they say they're investing in many companies. So is that considered as a diversification as well?
It really depends. When it comes to investment, right? I do have some clients of myself, like they are investors. So most of them, they might invest into a single market. What do I mean single market? For example, Malaysia. Because it's Bursa Malaysia, right? They have every stocks in hand is all under Bursa Malaysia. So this actually includes a very what we call a country risk. So just example, if let's say Malaysia today is not doing well, then Malaysia context is not doing well, then definitely the whole Bursa Malaysia is not doing well. So be your own portfolio as well. Because your own whole portfolio is into Malaysian market, so it's very hard for your investment to be performed as well.
Yeah, so I think when it comes to investment, most importantly, when we are talking about diversification, it is actually more about risk management.
True.
Yeah, so in risk management, I've studied before, there are actually many kind of different risks that we are taking when we are investing. Doesn't matter where we are investing into. So for example, like there are currency risk, and there are country risk, and also the industry risk, just to name a few. Yeah, so these are some of the risks that we have to be aware of when we are investing. Yeah, so talking about different kind of risks, and since there are so many kind of risks, right? So how can someone choose the right mix of investment, and how can someone determine their risk tolerance when it comes to investing?
Yeah, I think it's quite, because we're full with selections nowadays. So people nowadays are actually can invest in, because due to the convenience of internet as well, people can always invest in different kind of things, like what we said just now, unit trust, stocks, or even real estate. So when it comes to mix of asset, so we always talk about asset allocation. So of course, it's also need to see on your risk tolerance level. So what about we share about more on risk tolerance first? So when about talk about risk tolerance, right? We always talk about risk in managing your investment. It's because risk management is the key for us. So when it comes to risk tolerance, it's actually talk about two things. First thing is your ability, and of course, second thing is about willingness. We always only think about willingness. What do I mean willingness? Is always we do ask our clients one question: how much money you willing to lose when it comes to investment? So of course, we are not helping clients to lose money. But the thing is, when it comes to investment, definitely there's investment risk. So risk means you might lose money. So how much money that you willing to lose is a very key question where we talk about whether you are moderate risk, you are a risk averse person, very conservative, or you are a risk taker. So this is how we so-called categorize them. And of course, the first thing that I would say is ability. So it's totally different idea for ultra-rich people to lose 100K in investment and compared to a normal person to lose 100K in investment. Correct, right?
Yeah.
So yeah, for a lot of ultra-rich, maybe 100K is just 1 cent to them. So, but for normal people, it's totally different. 100K might be their whole life savings. So when it comes to selection of investment, it's really need to see about their ability of risk, ability, and also willingness of taking up how much risk.
Yeah, so when it comes to risk tolerance, right, I think a lot of people also misunderstand that they are risk taker. Yeah, so I think Ocean, that's about it for today. Yeah, and thank you for coming to our Finwealth podcast. Yeah, so I will see you guys.
Thanks for inviting.
Yeah, I will see you guys again on the next one.